Hey, what's up guys? John here. Jerome Powell just confirmed that interest rates are going to continue to rise throughout 2023. As that is happening, Warren Buffett is taking substantial investments outside of America and into other countries. Citadel CEO Ken Griffin is also doing the same thing as an extremely bullish position on China. And we have some other very unique things happening right now with one of the largest and most successful private equity firms in America, Blackstone. This company, they have nearly $1 trillion in assets under management. They founded Invitation Homes in 2009 that owns roughly 100,000 single-family homes. And they're doing something very unique based on this current environment that we're in right now. I'm going to break it all down for you so you can get a clear idea of where the everyday American consumer is and where we're likely headed as a country, what you can do to position yourself for success. Hit the like button. When you hit the like button, YouTube will share this content. It'd be great. Also, today's video is sponsored by GreatCreditFast.com. That's GreatCreditFast.com. If you want to fix your credit to position yourself for the greatest wealth transfer of all time, we'd love to help you at GreatCreditFast.com. Go there, schedule a free consultation. Take a look at this. So Powell expects more rate hikes ahead as inflation fight is a long way to go. Now, I've mentioned this before, but their only way of combating inflation and their only strategy that they're currently implementing is just increasing interest rates. They're essentially rug pulling the U.S. economy. Look what happened to Signature Bank, Silicon Valley Bank, First Republic, Credit Suisse. You start to look at this situation that's unfolding. It's a big rug pull on regional banks. It's a big rug pull on the everyday American consumer. Now, as we're moving into that direction, you would think if they're trying to draw inflation down to 2%, like he's been saying here, that they would simply increase fossil fuel production to drive down energy costs, which would indirectly pass along to consumers at the grocery store, and insurance rates. Everything would start to come down if prices came down. If prices came down for the distributors, for the manufacturers, for the farmers, it would reflect on us. Now, what they're doing instead is moving us into a world of hurt. Right now, 30-year fixed rate mortgages, if you have the average credit score in America, which is a 698, you'll be looking at an 8.037% mortgage. Now, some people might say in the comment section, no, John, you can get it for 7.5% or 7.7% if you have, like a ton of money down. You're not you're like the prime perfect borrower. Maybe sure, 7.6, 7.7. But today's rate, this is what they're saying, 8%. If you have slightly better than average credit score, 7.496%, right? We're headed for the average credit score borrower, mark my words, we're headed near 9%. That's where we're headed, probably by the end of the year. They're going to continue to hike and hike and hike rates. That's going to be a really big problem, not just commercial real estate, but for all homeowners that would need to refinance their properties, that need to get money, that really need a cash injection. To borrow money at those rates is going to be a big challenge for a lot of consumers. Now, look at what's happening with credit cards. The average interest rate is 20.69%. 20.69%. I mean, loan sharks charging 15, 18%. Hard money lenders are charging 12, 13, 14, 15%. You're paying almost 21%, right? They say, but 0% APR offers are still available. I've been talking about this on this channel. We have 17 trillion in outstanding consumer debt, and most Americans have a pretty substantial amount of credit card debt. A pretty substantial amount. It is nearly impossible to get ahead if you're paying somebody else 20 points to borrow money. That would mean you're borrowing 10 grand. It's going to take you nearly a decade to get out from under it. And when you do, you're going to pay back 30 or 32 grand. It's ridiculous. When there's another offer out there for 0% APR where you can transfer that 10K balance to them at 0% interest and pay and pay and pay and get out of debt for 0%. That's the plan. That's the strategy. It should be for people that have credit card debt. But you're going to need a credit score around 720, usually in most cases, to get approved for one of these cards. So again, if you need help fixing your credit, we'd love to help you get approved for something like that. But this is going to be a huge, huge problem. And we're already starting to see it right now in the automobile space. Car owners could discover that they owe far more than their car is worth. Now look at this right here. The auto industry pays close attention to loan to value ratios, the difference between the loan amount and the market value of the car. The higher the number, the more vulnerable the consumer. In the first quarter of 2023, the average loan to value on a used car bought was 125% average. So you buy a car for 10 grand, taking a loan for 12.5. Nuts. Up from 112% 3 years earlier. In this case, you'd owe 25% more than the used car was worth, right? What do people do when they're upside down on their car and they can't afford their payments? They're going to start walking away, right? They're going to start walking away from these cars, which who owns that debt? In most cases, lenders, banks, lending institutions. And when they start to see large write-offs in their auto loans, they start to see these write-offs happening in credit cards because they can't afford and they start to default on these payments. What are they going to start doing? Tightening these lending restrictions. Commercial real estate is going to really fuel that as well. And so, I mean, really looking at where you are and where you stand right now in this environment is so important, because these rising loan to values are important to consider according to a merchant, because they can be used to predict higher delinquencies among used auto finance customers, particularly subprime. Now, subprime borrowers, they're paying in many cases 15, 18% on an auto loan, 60-month auto loan, paying 5 years. Versus if you had good credit, it might be 3, 4%, 5%, 6%, something like that. But look at what Ken Griffin's doing. Ken Griffin, he came out in March, early March, I believe it was March 8th, and said that the consumers of America, everyday Americans, have $1 trillion in savings, $1 trillion, and they're burning between 120 and 140 billion a month, and by the end of the year, they're going to be out of money. Now, as that was happening, Jerome Powell didn't increase interest rates again. So in March, he increased one more time, but now we're going to be hiking 1, 2, maybe 3 more times throughout the rest of the year. So the cost of service debt is going to continue to rise. So they're likely going to burn through that money faster than he initially predicted. But look at what he's saying. Citadel founder Ken Griffin is anticipating U.S. recession, but holds more bullish view on China. In an interview in Hong Kong, the billionaire's flagship hedge fund had returned 6.1% through May this year, said he's pointing his attention towards high-yield credit markets during a potential downturn. We're much more cautious about 2024, he said. Per Bloomberg, we'll look at the credit markets as a source of opportunity. Credit should be a meaningful contributor later this year. He added he expects the Federal Reserve to hike interest rates one more time this year in 2023. Now, this article came out a week ago. Jerome Powell came out today and said that. So look at what Warren Buffett's doing, pouring money into Japanese stocks, And look at what Blackstone is doing. Blackstone is echoing what Citadel's CEO Ken Griffin just said, which is private credit, lending money to businesses, lending money to companies, private companies, because what's going to happen as the economy starts to contract, they're going to run into a liquidity crunch. They're going to run into a real big problem. This could give Blackstone, a lot of these private equity funds, opportunities to run out there and start picking up companies that have a lot of opportunity, but they're just poorly funded or poorly managed. Step in, give some advisory role there, and lend money. And what are they ultimately going to do? They're in many cases either going to get a pref on the money that they're lending, a preferred return, or they're going to start getting an equity or some of the upside when the company turns around. But look at how this is all playing out. One of the world's most storied asset managers, an historic opportunity for growth in private credit. This is also going to, I've mentioned this before, but Silicon Valley Bank, Signature Bank, and a few regionals, Blackstone's reaffirming its position as private credit provider in its Thursday morning Q1 2023 earnings call. Leadership emphasized the rising demand for private credit. And he goes on to say that due to these banks tightening up and a lot of the problems that are going on in these bank collapses, slew of bank collapses, that it's going to get harder to get funding. So they're going to be able to basically step in there with a bunch of other private equity firms and almost have like a monopoly on private credit. It's going to give them just an immense opportunity. They're already at roughly $1 trillion AUM, assets under management. Now, as they continue to move in this direction, they're going to really start to skyrocket. At Blackstone, total credit and insurance AUM increased 9% to $291 billion year over year, including $6.3 billion in inflows from its global direct lending strategy in Q1. Capital deployment reached $4.8 billion in Q1 and grew $39.8 billion over the past 12 months. The firm's private credit strategy generated a gross revenue of 3.4% for the first quarter. We believe it's going to be a historic opportunity for capital deployment in private credit. This is the CEO, Steven Schwarzman, said. Private credit net realizations, the actual amount of money paid back to investors, grew 21% year over year, over the past 12 months, and segmented distributable earnings increased 67% over the same period. We expect private credit and insurance to grow exponentially from here. The recent banking crisis triggered a pullback in lending across industries, creating an opportunity for Blackstone to intervene with private credit products. This is going to be huge. So mark my words. We're going to start to see more billionaires entering private credit. We're going to start to see more billionaires and wealthy companies and wealthy individuals start to move outside of America, expanding operations outside of America, integrating AI, robotics, and technology, doing all these different things to try to drive down cost as the U.S. consumer starts to step in to harder and harder times. They have less discretionary income. They're going to be putting much less money into the economy. And so smart and savvy investors are aware of that and they're planning. What do you think about it? Drop below, hit the like button. If you need help fixing your credit, we'd love to help you at greatcreditfast.com, and add me on IG for content I won't post here. Catch you guys in the next one.